Hello, everyone. Thank you for the outstanding interest in the UGRO Texas Premier Fund. We've already signed documents for over $50 million, and the fund is only open because we chose to go up from 6 properties to 8 properties, and we expect to close out the fund very shortly. Now, since the webinar, many of you have brought up the concern that interest rates are likely to rise, and you're concerned that when interest rates rise, they could cause multifamily cap rates to increase. When cap rates go up, prices go down. That's a valid concern. We agree 100% that interest rates will go up. It's likely that the Fed will raise interest rates twice next year by a quarter point each, and then twice again in 2023 by another quarter point each. So that's a total of 4 likely quarter point increases in interest rates before our properties come to market at the end of 2023. And this has led some of our investors to say that prices will go down, emphasis on will, in the next 3 years because of interest rate hikes. And we find those statements to be highly unlikely, and I'm going to prove that to you in less than 2 minutes. We like making data-driven statements, and the correct data-driven statement is in fact slightly different. I'm going to split that statement into 3 parts. First, as interest rates increase, they tend to exert an upward pressure on cap rates. That is quite true. But second, interest rates are just one of the many factors that exert upward or downward pressure on cap rates. Population growth, job growth, rent growth, institutional investor interest. There are other such factors that also exert pressure. Thirdly, and most importantly, over the last 10 years, there is no evidence that interest rates were the dominant factor affecting cap rates. Our research team has combined 2 very important publicly available charts to prove this to you. On the screen are 2 charts. At the bottom is the Fed funds rate over the last 20 years. And at the top are cap rates for apartments over the last 20 years. Now, as you can see from the top graphic, with the exception of 2009 and 2010, cap rates have been steadily decreasing. In fact, in the last 10 years, there is a consistent downward trend, so prices are consistently increasing. Now, I want to direct your attention to the orange vertical bar on the screen. Look at the bottom graphic and move your eyes to the orange bar. You will see that the Fed hiked interest rates a total of 9 times in between 2015 and 2018. You can see the rates going up here. Now, if interest rates were the only factor or even the dominant factor that's driving apartment prices, you would expect to see cap rates increase in those 3 years when the Fed hiked rates 9 times. But in fact, we all saw the exact reverse. Move your eyes up to the cap rate graphic, and you will immediately note that during those same 3 years, the cap rates for apartments kept going down at the same rate as they did before the hikes and after the hikes. And this proves beyond a shadow of the doubt that there are many other factors in play. And those factors like fear of inflation, the fact that the US is running out of low-hanging fruit land, a huge increase in institutional investor interest in multifamily. All of these are driving multifamily price growth. And don't forget that the UGRO fund is in some of the fastest growing cities in the US, and population and job growth are also driving prices. Bottom line, we feel that the data on the screen suggests very strongly that interest rate hikes are not going to have a substantial impact on prices. And if you have more questions about this, I'd love to talk with you. Email me at neal@growcapitalist.com. Thank you for your time.